Okay, so we're going to move forward and talk about accounts receivable. Accounts receivable obviously is an account where you've sold to a customer and now you expect that customer to pay you typically within 30 days. Accounts receivable is an asset because you could sell them. You could it's something where it should be changed into cash within a relatively short period of time. Here is a slide that basically tells you the percentage of total assets for different companies. Ford, they sell cars and trucks, so they will sell them to the dealers, and the dealers will owe Ford for these cars when they sell them. Caterpillar, same thing. Boeing, Amazon, and Tesla. Uh, Again, accounts receivable are amounts customers owe on account. A note receivable is a little different. It's normally longer and it's evidenced by a formal instrument. And there's also interest expense involved. Other receivables, non trade receivables such as interest receivable, loans to company officers, advances to employees, and income tax is refundable. Anything that says receivable means somebody owes you money in some form. Service organizations record receivable when it performs service on account. Again, we are under GAAP accounting, which means that we're under accrual-based accounting, which means that we recognize revenue when earned and we recognize expenses when incurred. A merchandiser records accounts receivable at point of sale of merchandise on account. Seller may offer a discount to encourage early payment. We saw that in the last chapter. Buyer might return goods found to be unacceptable. Companies record receivables in these accounts and they report on the balance sheet as an asset, reported net of uncollected accounts. So, in other words, unfortunately, not everybody is going to pay you. And you have to determine for accounts receivable the net. In other words, you have an accounts receivable balance, and similar to depreciation, you have a contra asset account. And so that means that you are estimating what you're not going to get paid. So, and that's called the allowance for doubtful accounts. And that's a balance sheet account, again, because it's a contra account and it's a contra asset account, it's going to have a credit or negative balance, whereas the actual asset has a positive or debit balance. And when you add the two together, you're going to get the net. When you make an entry into this account, this allowance for bad debt, that is actually what is going to determine your bad debt expense. So you have an expense account, bad debt expense, which of course is part of retained earnings. So a bad debt expense will decrease equity. And you have an allowance for bad debt. Here is an example of the accounts receivable. Assume, for example, that Warren Company writes off Doran's balance. Now, when you have a lot of accounts receivable, you probably are going to have a program that tracks all your accounts receivables. And so you'll have your accounts receivable balance will consist of one number, but that number will have lots of different balances to it. And that you will, again, normally track in an accounts receivable program. But at one point, you're going to go, well, this customer just simply isn't going to pay us. So what you would do then is you would write off the accounts. It's an asset. You're going to credit it, and you would debit bad debt expense. This would be the simplified version, also called a direct write-off. So the direct write-off method basically means that you're going to write this accounts receivable balance off when you determine that it's going to be uncollectible. Bad debt expense will show only actual losses from uncollectibles. So under the direct write-off method, you would debit bad debt expense and you would credit the account, removing that asset because it really is an asset. You're not going to get paid. And so in this case, you're just going to report the gross amount. There will be no allowance for bad debt. This is not acceptable for GAAP. It might be acceptable for small companies, but for GAAP, it is not acceptable. The reason is because you want to match revenue and expenses. If you record the bad debt only when you know that it's bad, then you're going to be recording it at a much later date. In this case, you will earn the income in 2027, but you're going to write off the expense in 2028. So really, you are underestimating expenses in 2027, and you're overestimating expenses in 2028. So you come up with a valuation account, and you're going to determine, based on history, based on the economy, what you think you're actually going to collect. So what your net that you're going to put on your balance sheet is what you actually think you're going to collect, again, based on history, based on the economy. You estimate uncollectible accounts receivable and match them against revenues in the same accounting period. So again, you're going to record the revenue, but then you're going to record a bad debt of the revenue you don't expect to collect. So again, the allowance for doubtful accounts is a contra asset account to accounts receivable. Here's an example. Hampton Furniture has credit sales of 1.2 million and 200 remains uncollected on December 31st. The credit manager estimates that 12,000 of these sales will prove uncollectible. So you are going to debit an expense, and when you debit expense, it lowers retained earnings, and you're going to credit the allowance for bad debt. Okay. And then you're going to have this $200,000 as your asset account, accounts receivable. You're going to have a credit of $12,000 in your allowance for bad debt accounts, a contra account. And when you add these two together, you're going to end up with a net accounts receivable balance of $188,000. So you expect to collect $188,000. And here is the how it would be presented on the balance sheet. Sometimes they just put the net, but then they'll put a note that tells you the accounts receivable and the allowance. Again, this is under current assets because you expect to collect this within more quicker than a year. So when you actually write off the uncollectible accounts under the direct method, that's when you hit the bad debt. But what happens is you have a beginning balance in your allowance account, and that's a credit. And then through the month, when you discover that you're not going to collect from certain clients, that is when you're going to start writing these accounts off. So you're going to credit the actual accounts receivable, and then you're going to debit the allowance account. So the allowance account again has normally a credit balance. So when you debit this, that means that your allowance account throughout the month is going to start going down. And at the end of the month, again, you're going to look at this account and you're going to make an adjustment. And normally you're going to raise it back up, which is going to increase your bad debt. And we talked in one chapter about segregation of duties. An employee authorized to write off accounts should not have daily responsibilities related to cash or receivables because you can collect cash and then just write something off and go, hey, this was a mistake. So, we're not going to collect this cash. Meanwhile, you've collected the cash and you've frauded your company or committed fraud. So here you have, when you actually write off an account, you're going to decrease your asset. and you're going to decrease your allowance account. So at that point, you have no impact on your income statement. And in fact, your balance sheet, the net doesn't really change because you're decreasing an asset and you're decreasing a contra asset account by the same amount. So your net really stays the same. 200 minus 12,000 is 188,000. 199,500 minus 11,500 is 188,000. So when you actually write the account off, what you're doing is you're lowering your allowance for doubtful accounts, which at the end of the month you'll have to raise back up to account for accounts that you're not going to collect. So here's the 188,000. So again, when you actually write the bad debt off, it has no impact on the income statement, and the net accounts receivable doesn't change. So you have a couple methods. You have percentage of receivables basis, and you have the aging the accounts receivable. And they're really fairly similar. And what you're going to try to do is you're looking for a target amount. So in other words, you're going to look at your accounts receivable balance, and you're going to say, all right, I've got a balance at the end of the month. Now that accounts receivable balance is going to change from the prior month. It's going to increase by credit sales. It's going to decrease by collections. So if I started out with $100,000 and I sold $1,000,000, that would be 1,100,000. But if I collected $900,000 that month, then my balance is going to be 200,000. I start with 100,000. I add $1,000,000. I collect 900,000. That leaves my balance at 200,000. And then of that 200,000, I have to estimate what I'm not going to collect. And so I'm really trying to determine the net amount. So what I'm looking for is a target amount in my allowance for bad debt. So again, you have your accounts receivable balance that's all set by your allowance account. So what you're looking for at the end of the month is you want to figure out, okay, again, if I want to be back at 188,000 and I have $200,000 of receivables, then I need to increase that allowance account up to $12,000 to get me back to that 188,000. And so these two methods really just show you, all right, how do we determine that target amount? Under the percentage of receivables basis, you just say history shows that we're only going to collect 90% of this account. So that means that you're going to go, well, I have to write off 10%, so I'm going to have a balance of $20,000 in my allowance for bad debt. And so I have a asset of 200,000. I have a contra asset of 20,000, which is a credit. So my net that I think I'm going to collect is 180,000. The aging is just a little different. So the percentage of receivables is much simpler. You just say, I'm not going to collect 10%, so that's going to be the target amount. Under the aging method, you're going to actually age based on how old the account is. So you might say, okay, I'm going to come up with a percentage for each category. So, for instance, if I have accounts that are 30 days old, I'm going to collect most of that. If I have accounts that are 31 to 60 days old, I'm going to collect most of it, but not as much as the most recent accounts. If I have accounts that are 61 to 90 days, I'm not going to collect as much as the last category, but I still am going to collect, maybe 92%. And so you come up with a percentage, you add all of those up, you multiply the percentage by the balance in that month, and then that gives you your target amount. Okay? So with the age of accounts receivable, you arrange the accounts by age and you determine the expected bad debt losses by applying percentages based on past experience to the totals of each category. And by the time you get out to accounts that may be 6 months old, you're probably going to write most of those off. So here's a representation. Again, you have a 27,000 balance in current. And so you think you're going to collect 98% of that. So 2% times 27,000 is $540. 1 to 30, you're going to collect 96%. 31 to 60, you're going to collect 90%. 61 to 90, you're going to collect 80%. Over 90, you think you're only going to collect 60. So again, it's 2% times 27,000. 4%, whoops, times 5,700. And so this is your target amount. So that's the balance you want in your allowance for doubtful accounts. So that represents the required balance in your allowance for doubtful accounts. So your actual bad debt expense is going to be the difference between the ending pre-adjusted balance and whatever the target amount is. So if you had $1,000, a credit balance of $1,000 in your allowance for doubtful accounts, again, you had to start with a balance and you wrote off all of this bad debt. So that decreases the balance. And so at the end of the month, you've got a balance of $1,000, but you need a balance of 2228. So your bad debt's just going to represent the journal entry needed to bring that balance up to $1,228, which would be 1,228. So that would be your bad debt. So the entry is going to be a debit to bad debt and a credit to the allowance account. So the target amount says this is where I want to be. The bad debt is going to be, well, where am I now? And what is the difference between where I'm at now and where I want to be? And so in this case, we were at 528. So we want a balance of 2,228. So it's $1,700 bad debt. Um, there are a lot of software programs. I used to work for a hospital company, and they had a program that would analyze bad debt for you, depending upon what vendor that you use, what insurance company that we used, whether it was a patient receivables, and then how old it was, and then it would provide us the actual. All right, here's what you should have in your allowance for bad debt accounts. The one thing about managing receivables, it has to do with, let's say that you decide I don't want any bad debt. So I'm only going to take customers that have a credit rating of $800 or 800. So that limits your pool. You only have so many customers that have a credit rating over 800, but you're going to get paid all of that. So now you go, well, I want to expand my sales, so I'm going to drop that down to 700. That's still a pretty good credit rating, but some of those people aren't going to pay off. So now you'll have bad debt, but you'll also have more sales because you have expanded your market. So now you have to have a allowance for bad debt accounts. You'll have to work those accounts. So there are additional expenses other than just bad debt. But basically, what you do as a credit manager is you have to come up with that sweet spot to where you're maximizing your net income and taking into account, well, again, I have higher sales, but I have a little more bad debt, and I have to hire people to work that bad debt. So what is my net? And so that's really what you're doing as a credit manager. Tableau, I'm not real familiar with Tableau, but I hear it's a great program. And so here's what you can use to sort of track your bad debt to go, hey, from these customers, you can track it over time. And a lot of times what you do is you'll look at, okay, let me look at sales a year ago, and let me see how many of those people have actually paid. But then you have to take into account, well, how's the economy doing? If the economy is starting to go down, then that means that people are probably not going to pay their bills as quickly or pay their bills like they used to. Brule has been in business 5 years. Unadjusted balance in the current year shows accounts receivable 30,000, sales revenue 180, allowance for doubtful accounts 500. Brule estimates bad debts to be 10% of accounts receivable. All right, so accounts receivable is $30,000. 10% of that is 3,000. So that's our target amount. That's where we want to be. We're starting with 500, so that means we're going to have to credit allowance for 2,500, and we're going to debit bad debt for 2,500. And so here we're just going to talk about inventories. These are probably in notes. Having too much inventory in hand costs the company money. And you see these sales, hey, everything 50% off. Okay, that affects your margin. But then if you don't have enough inventory, then you're going to lose sales. And then you have inventory turnover. It just means how quickly do you turn over your inventory. So I'm just going to quickly go over this because we have a section where we'll start analyzing, and that's when we'll start looking at these formulas. All right, so again, what we're looking at is we're looking at target amounts for bad debt, and we determined that by estimating either a percentage of receivables or aging of receivables. That will show us the target amount, and the bad debt is the difference between that balance in allowance for bad debt and the target amount, and that's what our bad debt will be.